Hello everybody, how we doing today? This is Dr. Sam. Hoping everybody is well. Hopefully you and your families are doing okay in this chaotic time. Hopefully we'll get better soon. Well, we're here to do our last unit of the term. This is referred to as Financial Condition Analysis, Chapter 17 out of your book. This material is found in a lot of financial analysis classes. Each one has a little twist, maybe some additional ratios, maybe some fewer ratios. But what we're going to do is take a look at the ratios that are in your chapter, and from there, figure out which ones you're responsible for. In fact, I counted 14 major ratios, and I'm only going to hold you responsible for 13 of them. As we'll go through the list, I'll kind of point it out to you. If you want to know right away which one I am ignoring, I'm just taking a look at the textbook here real quick. And the one that you don't have to do is the one that starts at the bottom of page 651 and takes up most of page 652. It is called the cash flow coverage ratio. That one you don't have to do. All right, but all the ratios before it and after it, total of 13, are the ones that you will have to do for me. Okay? And on the test, I may not have you do all of them. I just might pick and choose, but those are the ones that you're responsible for. All right, so what I did, let me bring up my Excel spreadsheet here, and it should be populating soon. Hopefully everybody can see it. So what I went ahead and did is I kind of copied the information out of the textbook, and you can see over to the left all the ratios you're responsible for. So profit margin, operating margin, return on assets, return on equity, current ratio, days cash on hand, debt ratio, debt to capitalization ratio, times interest earned, fixed asset turnover ratio, total asset turnover ratio. There's actually a whole bunch of more turnovers. Inventory turnover is another one, just to name one, but that's not something that's in our chapter or our book. Days in patient accounts receivables, so our patient accounts receivables, and then average age of plant or average age of our equipment or depreciable assets. So those are the things those are the 13 ratios you're responsible for. Now, what I went and did is I took all the information out of the textbook and recorded the industry answers that the textbook gave. So obviously we're talking medical industry in this particular scenario. And what I then did was I actually calculated and confirmed all the answers that were in the chapter, just to save us a little bit of time. By the way, this is going to be a pretty short video because I think the material, as I stated last week, is kind of on the easy side because all you're doing is really just executing these formulas. You just have to read the financial statements properly. I'm not even going to expect you to do tons of analysis, just basic analysis. All right. And what I did was I copied the answers. Well, like I said before, I didn't really copy them. I actually did the recalculation to confirm the textbook results, and the textbook was correct. And then reiterated what the author said if ours was better than theirs. So just real quick, for the profit margin, and I tried to make these parallel to, the actual ratio itself. So the profit margin, which is net income divided by total revenues. So if we were to take the net income, which is the 8572, and divide by total revenue, again, your total revenue is made up of your net operating revenue, and then don't forget there's some revenue down here too, which is some operating or some non-operating income as well. So to get this value of 7.5%, we took the net income, which was the 8572, and we then divided it by the total of all the revenue. So we've got net operating revenue, which kind of summarizes the entire top, okay, 112,050, but then we have some other revenue down here, okay, which is the non-operating, and that's the 2098. So what I thought we would do is, since your book did 2015, let's do 2014 since the data was presented. Okay, so that's what I would like to do with all of these. So it's basically redoing all the formulas out of the textbook, except textbook focused on 2015. We're going to focus on 2014. All right, so let's go ahead and do that. So if I execute the formula here, and if you have it in Excel, it makes life easier. So I think on my test, I'm giving you a Word document, but you could do the Excel off to the side if you want, and then, you know, copy the answers or just type directly into the Word document your results. So how you do it, that's up to you. But I'm going to take advantage of me creating this Excel document and just going through it that way. So we're going to take our net income, which is in 2014, $23.95. And then I want to divide it by my total revenues, and I have here 102,565, which represents my net operating revenues, but then I have this non-operating income as well. So I'm going to add those two together. They're going to get divided into the numerator, which was the net income. And let me clean this up a little bit. Turn this into a percent, and we're looking at about 2.3%. Okay, so the industry is at 5%. In 2015, we were at 7.5%. In 2014, we were only 2.3%. So if you compare, you know, this year, the first year, to the industry, we did worse, 2.3 versus 5. Typically, the higher the better. The higher the number, the better the answer. So if we're at 2.3 and the industry is at 5, not so good. In 2015, things improved. We were at 7.5, and we basically were better than the industry. So we have not only, let me do this to conserve some space here. So not only did we do better than the industry in 2015, there was improvement from year 2014 to year 2015. And that's important. You want to see good progress. You don't want to see the opposite. Okay? So not only are we comparing 2014 to the industry and comparing 2015 to the industry, we're comparing 2014 to 2015. So definite improvement from 2014 to 2015. So now let's do the next ratio, and that's operating income. And your operating income, as you can see, is 400. And we're going to divide that by the net operating revenue. And net operating revenue is right up here, which is the 102,565. When you do that, it doesn't look too good. Let's see if I can, there we go. Let me go a little bit further. Actually, let's turn it into a percentage, just like the other one here. There we go. So about 0.39%. So the industry was at 3.5%. We're at 5.8 in 2015. We were less than 1% in 2014. So again, 2014, extremely bad year compared to the industry, but we did see improvement from 2014 to 2015, which is good. and 2015 was so good it was even better than the industry. So if we were looking at just 2014, we'd be like, oh boy, we're not doing too good. But we saw what happened in 2014, or the management team saw what was happening in 2014 for this company, and made some adjustments, made some changes, and whatever they did wonders, because in 2015 we saw huge improvement. Okay, even better than the industry. Let's take a look at your return on assets, and that's your net income. And we want to divide that by your total assets. So now we're grabbing something out of the balance sheet, and basically let's put that into percentage as well. So about 1.6% is what I come up with, and if you compared that to the industry, we were worse. And then in 2015, we were better. So again, we saw improvement from 2014 to 2015. In 2014, we were worse than the industry. In 2015, we were better than the industry. Okay. Return on equity. So again, whenever you have a return on, you typically see net income in the numerator. Oh, and by the way, profit margin sometimes is referred to as return on sales, return on revenues, right? So return on revenue, notice net income over revenue. Return on assets, net income over assets. Return on equity, net income over equity. So we're going to take our net income again, and we're going to divide that by our total equity, which is the 98,792. And let's put this in percentage style. So about 2.4%, comparing that to then the industry, worse again. But comparing it to 2015, we saw some improvement. However, the improvement was good, but this is the first time that 2015 wasn't better than the industry. So yes, we improved, but we needed to do better in this regard. Okay? And if you read your book, it'll explain what each of these ratios are actually saying, indicating, but just kind of keeping it simple for us, right? Probably the most popular ratio in existence, arguably, is the current ratio. And that's comparing your current assets to your current liabilities. There's a lot of formulas or a lot of ratios that work off of this, like the working capital ratio, which goes current assets minus current liabilities. We even have something called a quick ratio, or an acid test ratio, that takes the current assets and makes them even more liquid. But we don't have to worry about that here. But if you notice, in 2015, we were better than the industry. You want to be about 2 to 1. So the industry's good, we're a little bit better than the industry. Let's see how we were in 2014. So if we take our current assets, 28,815, and we divide that by our current liabilities, and I get 1.715, right? So about 1.72. 1.71, whatever, to 1. So again, in 2014, we were worse than the industry, but even if we weren't comparing ourselves to industry, 1.71 is a very, very poor current ratio. You want to be at least 2 to 1. So for every current liability, you want to have at least double the amount of current assets. That is the rule of thumb that you want to follow. All right, but as we've been seeing so far, again, improvement from 2014 to 2015. So if you're given 2 years worth of data it's important for you to see how things have evolved from one year to the next. If you only have 1 year of data, then you want to compare it to the industry. If you have no industry or nothing else to compare to, these numbers are kind of meaningless. You can't really conclude unless you're talking about like the current ratio, which is should be 2 to 1, but these other ones, may not have an automatic number to look for. So you always want to be to compare, something to something to really get a true indicator. Okay. So let's take a look at this next one. Days cash on hand. So how much security, how much of a money do you have on hand for, certain situations? So the industry has about 30 days of cash on hand. We only had about 22 days cash on hand in 2015. So not so good. You want to have as much cash. You don't have too much cash, but you don't have like 1,000,000 days worth of cash on hand, because then it's like you're not utilizing your money properly. But you want to be at least better than the industry, and if hopefully we're better than we were the year before. So let's find out. So in this particular case, we're going to get our cash and cash equivalents. So let's see, we've got cash and cash equivalents. That's the 3,095. And we're going to add our short-term investments. Right? And then we want to divide. This one's kind of tricky because of the way I have it set up. We want to divide by our operating expenses. And the operating expenses are right here, so I gotta make that a negative. And then I want to subtract out my depreciation and then divide it by 365 days. And I get 18.95. Let me see, I did this before. Yep, that's exactly what I got. So 18.95 days. So look how much cash on hand we had in 2014. And then in 2015, we had about 22 days of cash on hand. The industry is about 30. So we did see improvement. So even though these are crappy results compared to the industry, we see a light at the end of the tunnel that we're improving. So it's kind of interesting how you can look at, how you look at the glass. The debt ratio, total debt divided by total assets. So go to our balance sheet here and we find our total liabilities, which is the same thing as total debt. So total liabilities is 49,858. We can divide that by total assets, 148,650, and let's convert that to a percentage, and that's about 33.54%, right? So we had more debt last year. Let me just make sure I have the right same answer as before. Yep, so about 34%. So in this situation, the lower the number is actually better. So that's why if you noticed with the debt ratio in 2015, we were at 20%. The industry was at 42%. So a lot of hospitals on average carry a lot of debt, and we weren't carrying as much debt. We had more debt last year, so we got rid of some of our debt. So we were still better, first time that we were better than the industry in 2014, even better in 2015. So again, improvement. So that's a good sign, right? So that's always kind of funny because depending on your point of view, some industries or some businesses want to carry more debt, but the more debt you have, the more leverage you have. So, the industry here is more leveraged than this particular, clinic or hospital. So sometimes the more you leverage, as we've talked about previously in this course, the more you have at risk, the more you can gain. But the more you have at risk, the more you can lose. So we're at a more conservative standpoint. And maybe by looking at the debt to capitalization ratio, we may be able to shine a little bit more light on this. But you'll notice that we were still better than the industry from debt to long-term debt and equity. Let's see how we were doing in 2014. So if I take my long-term debt, which is $30,900, and I divide that is that my total long-term debt? Nope. I knew something was goofy. Hang on a second. So my total long-term debt is actually this number. So 33,055. And I want to divide that by that same number, 30,055, plus my equity. And I get about 25% in that regard. About 25.1. So again, we were better than the industry, and we also reduced our debt. So there was improvement from 2014 to 2015. So look at our column I here. You know, sounds like I said calamari. Wouldn't that sound good? Anyways, a lot of improvement from 2014 to 2015. And comparing 2014 to the industry, more lousy than good. In 2015, a lot of good, and only one situation where we weren't as good. Times interest earned. A lot of times when a small business is applying for a bank loan, a bank will run a series of financial ratios, probably even more than the 13 that we're doing here. And one of the ones that the bank is really interested in, along with all of them, but this one tends to kind of peak out a little bit more than the rest, arguably. This is times interest earned. So a bank wants to know, how good are you right now in covering your interest payments with the current loans that you have? If you're having trouble now, they're not going to loan you more money, all right, to get a new loan. So they want to see this number as high as possible. So if you look at the typical industry, there's a 4-to-1 difference between interest expense and EBIT. So EBIT is 4 times greater than interest expense. Remember, this is earnings before interest and taxes. In 2015, this company was at 6.56 to 1, so really good. All right. Again, it should be good because remember, they have low debt. So because of the debt ratio, they have debt to get, or if they apply for debt, they might be able to get a good rate because they're not carrying a lot of debt. They're a lot lower than the industry. Let's see how we were in 2014. So if I take my EBIT, now I actually did not set up the income statement in that style where EBIT is one of the lines. So we're going to have to improvise here a little bit. So we're going to take our net income of the $23.95, and I'm going to have to add in my interest expense. So that would have been my earnings before interest, right? And then I want to divide that. Did I close my parentheses? Yep. I then want to divide that by my interest expense, and I come up with 2.57. Whoops, wrong way. So 2.57 to 1. So you can see we were worse in 2014. We could only cover our interest about 2.5 times. By 2015, we could cover it 6.5 to 1. And then the industry 4 to 1. So we were worse than the industry, but as we've seen in every situation so far, we've seen improvement from 2014 to 2015. So this is what I'm going to be asking you to do. If you have a test question, I might ask you, is it better or worse? Is there improvements, that sort of thing. I do have one question on the test that will challenge you to think out of the box to kind of recreate a financial statement based on ratios. You may opt not to do it, but on this exam, you have 6 questions and you have to pick any 5. So 5 out of 6. Okay, and they'll be worth 20 points each. All right, and you'll have a week to complete it. I'll upload it today, and hopefully everybody can get it to me by next Monday. Just reaching for my calendar here. The date next Monday is May 4th. Wow. By the way, update on my cancer situation. Got some good news in terms of what they're going to do to treat me. On May 14th, I'm having surgery called a HIFU technique. I think I mentioned to you that was a possibility. High intensity frequency ultrasound. So they're going to go in and they're going to just do a localized kind of like melting of the cancer, kind of dissolving it, burning it kind of thing. And of all the potential things that I could have had done, this is probably the best outcome, so hopefully, I still have to get like random checks, blood tests, PSA checks, and probably another biopsy down the road, and then probably another MRI down the road just to make sure it's all gone and nothing's come back. But of all things that could have happened, other than, a miracle having the cancer gone, this is probably the next best thing that could have happened in terms of, it's not the major surgery. They're not removing the entire prostate. They're just kind of going there and doing a small percentage, and the negative side effects are less than 5% from this procedure. So thank you for all your good wishes and prayers, and keep them coming, all right? Because that's happening on May 14th, so this will probably be my last update for you. And, so I said test is due on Monday, on the 4th, okay? And I'll upload it as soon as we're done with this session, which won't be much longer. Okay, so now let's go over to the turnovers. So we've got a fixed asset turnover ratio, total asset turnover ratio to do. Like I said, we could have an inventory turnover. We could also have one more that I probably should have you do. Make sure everybody writing this down. Let me make sure you got a pen. All right, write this down. One more turnover, and that's called the Apple turnover. I can't let you go without one bad dad joke. So, because I said that, when you text me that you've watched this video, I want you to tell me hello, as you always do, and then include in your text Apple turnover and what the formula would be if we were doing a formula for Apple turnover. So look at number 10. Fixed asset turnover is total revenues over net fixed assets. Total asset turnover would be total revenues over total assets. What would the fake formula be for Apple turnover ratio? So that's what you have to text me, all right? If you text the right answer, I will give you a bonus point on this final test, all right? So no matter what your score is, I will add a point if you come up with the right formula for the fake Apple turnover ratio. I'm always trying to find you some points. Okay, so let's continue with the remaining ratios. So the fixed asset turnover ratio we want our total revenues divided by net fixed assets. So let's find the total revenues. And we've got net operating revenue of 102,565, but there's another one at the bottom, don't forget. So 102,565 plus this non-operating revenue of 1995. And then we want to divide that by our net fixed assets, and that's basically your net property, plant, and equipment. The fixed assets are basically those assets that get depreciated. Okay, and I get 0.8725. Let's clean that up a tad here. Oh, wrong way. 0.873. So comparing that to the industry, shocker, we were worse in 2014, but notice there is an improvement again from 2014 to 2015. In terms of the total asset turnover, again, we're going to take our total revenues, so 102,565 plus this extra one down here, and now we're going to divide that by total assets, which is 148,650, and I get about 0.703 to 1. So about 70%, actually less than 1 to 1. In fact, the industry is less than 1 to 1, but they're almost even 1 to 1 there. So I think none of these are very good. Not us, not the industry, but there was an improvement. From 2014 to 2015, but we're still not as well off as the industry. As you can see, both this year, or 2014 and 2015, were worse, but we did see an improvement. Days in patients' accounts receivable. This is a really good one too. This really helps a company to analyze how they're collecting on their accounts receivable. So currently the industry, it takes about 64 days to collect money from the patients. In 2015, it took this company 77 days. So let's say, I don't know if you remember from your accounting experience, if you remember selling things on account, it was like 210 net 30 or something like that. So if you have net 30, if you expect to collect money within 30 days, even the industry would be poor, very poor, because it's taken them 64 days. If the industry gave their customers 60 days to pay, this would still be poor, because it's taken them 64. If the industry gave their customers or patients 90 days to pay, then 64 is good and 77 is good. So we don't know what the typical time frame is, but if you know what that is, that'll help make your decision, easier in determining whether it's, worse or better. So let's actually calculate 2014's. The net patients accounts receivable, that's right here, 20,738, and we're going to divide it by the net patient service revenue, and that's about, as you can see there, 0.2256. Is that right? It seems a little low. Let me redo that one. Hang on. I'm going to get that net patient accounts receivable. I don't know if I clicked on the right one last time, and divide it by the net patient service revenue. Why am I getting... Oh, you know why? Because I have to divide it by 365. Duh. Alright, that explains it. So let me fix this. I'm wondering, why am I getting a decimal answer? So we're going to do that. And Divide by 365. And 82.339 days. There we go. I wasn't thinking. Forgot about the 365. So look how long it took us to get money from our customers on account. In 2014, it took us over 82 days. And in 2015, it took us 77 days. The industry is getting their money in 64 days. So again, improvement. But we got a long way to go. We have to improve our debt collections. And then finally, your average age of plant, basically trying to figure out how old your assets are. The industry is about 9 years old, is their equipment. Ours is about 6 years old, so pretty young compared to the industry. So that's definitely better. So in this case, smaller is better. Okay, let's see what we were at in the previous year. So if we take our accumulated depreciation, which is 21,030, and I divide it by my depreciation expense of 4,025, get about 5.22. So for the first time, actually, well, we are better than the industry, but we actually did not improve. But that's expected because last year our assets were about 5 years old on average, and after another year they're 6 years old. So we did not improve in regard. So in other words, we didn't buy any new ones to kind of bring this number down, but we're still doing better than the industry. So let's just say no improvement. Okay, so that's the kind of stuff that you may need to look at. I don't know if I have a question that has you do all 13 formulas. I don't remember exactly, but you'll see, and you'll get to pick, basically 5 out of the 6 questions that I've given you. All right. So other than that, like I said, I told you this would be a short video. So remember this time when you text me back that you watched the video. By the way, thank you for the selfies and the thumbs up. That was great. I didn't get everybody's text though, but this time you are texting me the formula for the Apple turnover ratio. All right. So what's the deal? I need by next Monday, I need your budget assignment, and I've already received quite a few from a lot of people, so that's great. Thank you for getting that in ahead of time. So I need your budget assignment, and I need your test by May 4th. So you have 1 week to kind of do this test and put the finishing touches on the budget assignment. All right, that's it. We've survived this chaotic, never before seen, unless you count 1918, all right, but never before seen in our lifetime. And I think we are really learning how to cope and figure things out, and hopefully we'll be stronger for it. And hopefully our government, our medicine, our supply chain has all learned a very valuable lesson here. Let's make sure that, we learn how to make all these things that we need here in the United States, right? Instead of trying to get this stuff from China or wherever it might be. Even though it might cost less to do work outside of this country, we're paying for that right now. All right. So hopefully everybody will be safe and everybody will be healthy. And hopefully I'll see you guys in the upcoming semester, whether in person or on Skype or in, maybe we just happen to be passing along, with our little masks on and whatever. All right. Have a good one. Take it easy. Bye-bye.